If you look at a company balance sheet, you might see a term called the LIFO reserve. Let's break down what that actually means. The term reserve is a bit misleading here. It is not a pile of cash sitting in a bank account waiting to be spent. It is simply the mathematical difference between the inventory value under the LIFO method and the value under the FIFO method. Companies use this to help investors compare their performance against competitors who use different accounting methods for their inventory costs. LIFO assumes the newest items are sold first, while FIFO assumes the oldest ones are. This creates a gap in reported inventory values. In an inflationary environment, the LIFO reserve grows because the costs of new inventory are higher than the older costs on the books. Remember that this is a reporting tool. It helps analysts see the true economic impact of inflation on a company's inventory. Understanding these adjustments helps you peek behind the curtain of financial statements. Thanks for watching and keep learning.